everyone, welcome to this week's episode of Market Watch. I am Sylvia, an equity specialist from PhillipCapital. In the first half of 2020, we saw the S&P 500 plunge more than 30% from its record high due to the outbreak of the coronavirus. With the impending fear and uncertainty of the economy, investors started selling off their assets, leading to the major sell-off in March. However, to our surprise, the market has gained a strong comeback in the following months, and the year-to-date performance as of end June is just slightly below 5%. According to SP Global Research, the most affected industry in March was the airlines industry, as represented by the light blue line. It had the largest increase of the median probability of default from 9.84% to a high of 25.2%, as planes were grounded and borders were closed to prevent people from travelling so as to curb the spread of the coronavirus. This has led to a sharp decline in revenue, leading to an increase in its probability of default. Secondly in line was the casino and gaming industry, as the median probability of default increased from 6.41% to 16.4%, as they were forced to close due to safe distancing measures. For example, Caesars Entertainment has reported a significant decline in revenue in the first quarter of the year as it was forced to close its casinos worldwide and has estimated a daily cash burn of $9.3 million. With such a high daily cash burn rate and low receipts from tourism, it may be hard for them to sustain their businesses in the long run. To help cushion the economy, the Fed has announced various measures including cutting of interest rates to a range of 0 to 0.25% and expanding its quantitative easing program to help support the economy. It has also created new credit facilities to help businesses and injected liquidity into the market. The market has since shown some improvement and the Fed tapered its purchases. If you are looking to invest, here are some of the sectors that you can look out for, namely communication services and consumer discretionary sectors. The communication services sector include companies that provide internet services or wireless access and services. This includes Facebook, Alphabet, and Netflix. For instance, Netflix saw an increase in its subscription during the first quarter of the year, contributing to the growth in revenue of 5.49% quarter-on-quarter. As more people spend more time at home during the lockdown period, they will tend to watch more television and entertainment programs, hence leading to an increase in subscription and demand for the products, contributing to the growth in revenue. If we take a look at the Communication Service Select ETF, for which the underlying stocks include those companies, we can see that year-to-date, it has outperformed the S&P 500 when it recovered from its lowest point, and there is still a potential to grow in the upcoming year. In addition, we can also look at the consumer discretionary sector, which provide goods that are not necessary, but people who want to buy if they have enough disposable income. These include high-end apparel, entertainment and leisure activities, and also vehicles. Based on a research finding by McKinsey, consumers tend to postpone or cancel purchases of big-ticket items during bad times, and they expect to reduce spending this year until they recover part of the income or savings that they have lost during the lockdown period. Also, those who spend less now also plans to increase spending in future. As such, we are likely to see an increase in demand for discretionary goods when economies reopen. Looking at the consumer discretionary sector ETF, for which the underlying stocks in the ETF include McDonald's, Nike, and Starbucks, we can see that there is an outperformance of the market year-to-date, and we can expect more room to grow when the economy recovers. Furthermore, if we were to compare the chart to that of the recession period, we can see that the sector, as represented by the green line, has outperformed the market when the economy was recovering. But of course, past performance may not be reflective of future performance, and that this is just a consideration that the sector tends to outperform the market in times of bad economy. In the past few weeks, some countries have started to lift their restrictions and reopen the economy. However, we see that some countries, like the United States, are closing it again as there was a resurgence in cases. Well, I feel that there is still a risk and a fear of the second wave of the outbreak, and this may lead to another sell-off. Nevertheless, you can keep a lookout for the above-mentioned sectors and be prudent in your investments. With that, I thank you for your attention and feel free to drop your comments below, and do remember to like us and follow us on our social media page. Thank you.